All right, guys, welcome to the new year. Let's see, start up in a second as soon as this gets recording. Okay, great. Well, Happy New Year, Portfolio Builder members. Today's trade alert is exactly the same as last Thursday in terms of the strikes. We're just pushing the expiration a week further. And my commentary to our internal team was that the TLT is hanging on for dear life. You can tell it's dying to sell off. And just to look at today's trade alert really quickly, the bet is down and will be for the foreseeable future. The rest of our portfolio is on fire with big gains. We'll take a look at that. And if you're just covering your position now, you may actually be closer to break even on this trade. I lost a little bit on the TLT trade, but up handsomely on GDX, emerging markets, and as well the SPY. Now we have twice as many shares of GDX and emerging markets. So those gains are certainly the most exciting this morning. To just summarize this trade, it's what I call the inverted option caller. This is where we sell an in-the-money call option and buy an in-the-money put. And it's a clever way to bet down on an asset with low risk. So week over week, we can lose about 1% in 40% of our total assets. So maximum loss on this trade alert from here till next Thursday is 0.4%, or just under 0.5% of our total portfolio. What can we achieve in gains? Just over 1%, maybe 1.25%. Now, because of implied volatility and a little bit of time premium being left, we might actually get a slightly higher return than what this indicates as a maximum profit of $170 per contract, $1.70 per share. So about $1.25 or 1.25% maximum return week over week on this trade. If we jump into today's trade alert, the math to audit this return is to compare the trading price of the TLT week over week. So the TLT was slightly higher this morning. Right now it's starting to sell off a little bit. Now, at the close of Tuesday, we were trading at 135. So we were sitting at our maximum profit, but it did jump up a little bit this morning. And again, we were short the 135 call, long the 138 put. We collected a credit of 17 cents. Last Thursday to open the position, we had to pay $1.15 to get out of the option cost for a net loss of 38 cents, or in our portfolio, which is approximately a $1.5 million portfolio, a loss of $1,444 week over week. Now, these losses were dramatically offset with our gold and emerging markets position. Now, these positions were put on with a simple married put. So we own the underlying asset, and then we purchased downside protection expiring January 10th on GDX and emerging markets. The strategy with those two trades was to try to save on downside protection and capture a very large upside move. And when we entered these positions, we actually entered into the position with the maximum loss on day one. That's because we purchased a put option that was trading above the current trading price. So you can see when we entered this trade on GDX, we bought the 28 put, and it was only trading at 27.46. So we had to work off $1.15 of insurance to even get into the green. So for those of you who've been watching slowly but surely the GDX rise, we were paying off that put option. And now in the last week, really, we've seen gold start to really shoot up. So we're actually up 93 cents on this position, or $3,534 per share. Now, if we were just writing it naked with no put, we'd be up significantly more, twice as much. In fact, 120% more approximately. So for the past 3 months, gold been selling off, and it hadn't been giving us the right price action. So it did make sense to play it safe, even though we had the Fed expanding its balance sheet by $100 billion a month. It took a little while for that to work its way into the system. So we're remaining long gold. My expectation for gold is a good year in 2020, but an excellent year in 2021 and 22. And this is going to all have to do with when the Fed is forced to cut rates again, which I suspect will be in quarter 3 or quarter 4 of 2020. Now, there's some people trying to predict this is all going to happen in quarter 1. Namely a guy named Zoltan, who used to work for the Fed. So he's highly qualified to make such predictions. And he was doom and glooming a lot of problems that may happen in the repo markets over the last several days. So far, those have not materialized, but to give him credit, the Fed did react to his essay and liquidated the market with $500 billion in repo operations. Now, also keep in mind, every Thursday at the market close, they do update the Fed's balance sheet. So Friday, and now that this has certainly become a trend we can count on, every Friday we'll be looking at how much the Fed has increased its balance sheet and have a pretty good idea of how bullish we should be on equities and bearish on bonds for the week ahead. So until they stop adding to their balance sheet, this will be quite an easy piece of news for us to evaluate each Friday morning. So do join us live tomorrow, as I'll be focusing that piece of news every Friday, coinciding with our SPY trade, and then of course into the Tuesday trade with emerging markets. Now, emerging markets, we did the same setup. We got caught off guard. We could have been up substantially more in emerging markets, but if we go back to 2019, we've been betting down on emerging markets because Trump came out and said, you know what, we're going to push the trade deal to 2021. And that gave the market quite a scare. We bet down on 1 week. And then on the 17th, we flipped to a bullish trade. We bought the in the money put. So you can see again, we were trading at 44.21. I bought that right at the money put option, slightly in the money, so that we would realize our maximum loss at that very moment in time, and then simply sit and wait for emerging markets to appreciate, to go up in value more than our downside insurance protection. So that downside insurance protection costs 61 cents. And currently we are up, oh, I'm sorry, there is a typo here. We're up 70 cents. So I will recalculate that. But this does remain our very highly profitable position. So I will update that, folks. Sorry for the discrepancy there. I'll update that tomorrow. We're up considerably on emerging markets, going from 44.21 to 45.52, up about $1.30. We had to give back 61 cents. So we're still up over $1 on this position. The SPY trade is a little more complex. We have a tight option caller. The SPY's been outperforming all world markets. So there's a lot more downside risk in something like the SPY trading at very high PE multiples relative to something like emerging markets. So that's why I'm willing to take a lot more risk on our gold and emerging markets position. Not only are they still undervalued, they're also a much smaller piece of our portfolio. So we have 10% in GDX, approximately, a little less, and 10% in emerging markets. SPY is a 40% position. So we're playing it much more tight. And so in this trade, we have the tight option caller protecting the asset. And then we're long the 325 call with a little extra duration. So currently we traded this from 321.37 to 323.16, which is a substantial gain. We didn't capture the entire profit yet. Now we will potentially have a bigger profit tomorrow as time premium erodes on the short call we sold. But even with the drag from the options, we're still up 84 cents a share, or $1,596 in our portfolio. The December return is a 1.8. Now, a note, I did add in all our dividends from the year. Moving forward, I will input the dividends on the month that they were received. Our total return in 13 months is 17%. Maximum drawdown is $1 for a month-to-month close. Now, that doesn't mean we may not have had slightly larger drawdown intra-month. I would estimate our largest intra-month drawdown is around 2%. But if you look at that, you're risking around $1 to make 17. That's very, very hard to pull off. So we're very proud of this portfolio. And it wasn't done by being just long equities and getting lucky. It wasn't done with closing your eyes and hoping stocks rebound. It wasn't done with anything speculative. We had a very weatherproof, uncorrelated portfolio of the most important assets in the world. And so that's what this is all about. We own the most important assets, focus all of our energy on predicting the moves of these key assets. So that's US equities, emerging markets, the US bond market, and then finally the inflationary play in gold. I'll update our returns through December and add that hopefully in tomorrow so we can see how we did against the S&P 500. To review our trading plan, again, we're trading the SPY Monday, Wednesday, Friday, emerging markets Tuesday, TLT and GDX on Thursday. And again, at the bottom of your email, you have your tutorials on how to enter and exit positions. So if you're new, that's very useful for you. Now, I do see some questions. Okay, one fellow did not get his trade on the phone today. We'll check on that for you, John J. And I think we have Ryan listening in who handles delivery issues. So I'll make sure he gets that fixed for you and send out a test text message.
Yeah, absolutely, Jason. I just asked him for his cell phone as well, and we'll get that right out to you, John.
Okay, great. Excellent. So here's how we exit the previous trade in step one. If you didn't take the last trade, you would skip this step. But if you did take it, buy to close your short call, sell to close your long put. It's just that easy. Stay long the TLT and then roll into the next position. So you will sell to open your 135 call and buy to open the 138 put. Here's your risk graph. If you look left to right, that's the future price of the TLT. If you look up or down, that's your gain or loss based on the price of the TLT. So in this trade, we're standing to risk around $116 per contract and standing to make around $183. So we love that risk to reward ratio. And again, I suspect this will be the trade of 2020 for at least the next 6 months. Now, does that mean there might not be some upward moves in the TLT here and there? Sure, but I think the big trend is going to be a vicious drop towards 120, where I think that will force the Fed to start cutting interest rates. If we look at step 2 for GDX, no actions for anyone who took our previous put option. Just hold your position into next week. We'll most likely start doing that very wide option caller, so a very loose option caller moving forward. But this was an easy trade to get us through the holidays and to take advantage of what I was expecting would be a pretty significant move in GDX and emerging markets. So that's finally coming to fruition in our portfolio. Max Pula says, why GDX instead of GLD? Yeah, I think GLD is going to go flat and GDX is going to rocket higher. So that's why, Max. GDX will benefit from 1,500 spot gold and central banks will buy up gold almost at an unlimited quantity around 1,500 to 1,600. So you might make a tiny return on GLD, but we can double or triple our money with GDX. Okay, so that's a wrap on the trade alert. Any questions out there before I jump into the news and the charts? Scotty's got the trades following again. Very good, very good. Okay, I see a question from Galaxy S10e. I've unmuted you. You can speak if you have a mic, or you can post a question in the chat box.
Yes, I'm not too familiar with the puts or the options. So with the GDX, how do I put that in for options?
Sure. So step 1, you buy 100 shares of GDX.
Okay.
Step 2, you will buy to open the January 10th $28 put option. Now that's not providing you a whole lot of protection, but it only costs 4 cents. So it's pretty cheap downside protection. We'll be starting to manage that position again more actively next Thursday.
So I buy to put with an option to, we're open at January 10th, so it's a put, right?
So step one is to purchase 100 shares of GDX,
Right,
or rather 200 shares, more likely if you're following the full program.
okay,
And then you would, for every 100 shares of the GDX, you're going to protect that with one put option contract.
oh, it's a contract, okay, I'm not too familiar with the puts, okay.
Sure.
And that,
So you might be a great candidate for our boot camps, which is really detailed beginner level options trading. But just to tell you what this means, if we buy to open the January 10th, 2020, $28 put, usually it's a big bank who underwrites the puts. So they're selling the put option, we're buying it in this example. They're agreeing to buy your shares of GDX for $28 no matter what price GDX trades at. So if GDX were to crash, as Max Pula is afraid of, we're protected with downside protection from our put. So it's kind of like buying life insurance or health insurance, something of that nature. And so yeah, so that's a good deal, but you're trading at 29.62. So you're going to lose at most $1.62 plus the cost of the option, which was 4 cents. So you're looking at entering into this position with some downside protection, but not a whole lot, because you won't really realize that protection until you get below 28.
right, because we're picking it up at 28, okay.
So that's a
Okay.
little more risk than I'd like to see someone joining into that position have, but it's the position we've had for the holidays.
So you think I should hold? I have gold and silver, so,
Yeah, so I think gold and silver, well, silver might have some upside ahead. Gold's probably going to trade very low returns in 2020. I think your gold miners will be where you want to have your fun. So the basic idea is the central banks are picking up spot gold at 1,500 an ounce at
yeah,
massive pace. So that's kind of a ceiling on spot gold. So I
right,
don't think we're going to see a huge run up in the price of spot gold. It's the people who mine the gold right now that have a good opportunity to start generating profits. And gold miners
Right.
have a rough life. I mean, they have had a very tough decade, really, with a few years that were hot here and there. So that's why we like gold miners versus. But yeah, no, this is my favorite position. I think we'll be long GDX longer than any other piece of our portfolio. So we'll have to
yeah,
be careful about navigating stocks and bonds. But at this point, gold looks just about unstoppable because of where we're at with central bank policy.
yeah, I have NEM, and I have Barack. Barack isn't doing so well, but the other one was doing fantastic. New mining, yeah.
Yeah, Newmont. Yeah, so those are all the same. You're much better off with GDX. If it were my portfolio, I would get rid of all of that and just have blocks of 100 shares of GDX. And the main reason why is it's going to make your life so much easier to remove volatility by trading a ETF. Because guess what? Those two companies are the single largest positions in GDX. But now I can protect that entire position with one put. With your portfolio, you've got gold, you've got silver, you've got a couple random gold mining stocks. So how are you going to protect against that? It's pretty hard for you to calculate that. If you do consolidate into just GDX, your life's going to get a lot easier, especially when we start selling a out of the money call option to finance our downside protection. So that makes it a very beautiful way to get free insurance on the riskiest part of your portfolio, which is by far GDX.
Great, okay.
But
I'm
it's
glad I-
also the one that can give us a lot of return when we understand the big picture. Makes a whole lot of sense. Also, Scotty, I hope you're taking those boot camp trades. Those are killing it today on the two English banks and then the two copper companies.
I wasn't taking the boot camp. I just got in. So I just got in like a couple of days ago. So I didn't, I didn't even see the ad till just now for the boot camp.
No worry. Those positions we'll probably be holding for the better part, with maybe a little bit of hedging, but our goal is to hold those for over a year so we can get the low tax rate. And yeah, those are really good picks for sure. I don't know if you're, who are you? Sorry, Galaxy S10 is all I see on the name.
Oh, Dolores Baker. I'm sorry.
Oh, cool. Well, yeah, if you're not in the boot camp yet, definitely consider it. We have some deals that get you into the boot camp as part of the advisory, at least for a trial period. But yeah, we have 4 stock picks in our boot camp that represent 5% of the total portfolio that are just simple buy and hold specific companies, 2 English banks taking advantage of Brexit, and then 2 energy plays that I believe will outperform. There's a lot of money pumping into energy right now, but I believe these 2 copper stocks will do far better because of electric vehicles becoming so important into this decade.
I'm so glad I could talk to somebody. Wow, this is great. Yeah, because I just got into this.
Yeah, we're the only advisory that has access to an entire team to support you daily for a couple hours. We're usually on here for about 2 hours. Now, the boot camp operates on Monday and Tuesday after the advisory. So this is the advisory strategy webinar where we talk about the very simple trading plan, how to get in and out of the positions, and that's about it. That takes up a good 2 hours each day. Monday, Tuesday is when we do our boot camp content, which is, it does have some bonus trades on Fridays, some of which are just to buy and hold outright. And then it has the additional education. So on Saturday, you get a list of videos to study, usually about 5 hours of content, not content I've produced, content I've collected throughout the week, the best of the best in terms of interviews. And then on Monday, it's our boot camp Q&A. So we're going to review our open positions and onboard new members. And the way the boot camp operates, it just repeats itself over and over again. So you purchase it one time, you're in for life. And this way it allows you to join in and not miss out on future content or have to wait. A lot of people are like, oh, should I wait half a year to get into the boot camp? Well, the answer is no, because I do an onboarding Q&A webinar so that I can catch you up with the previous modules and then get you on track for future modules. And again, it repeats every 6 months so that if you didn't get everything the first time around, you can keep learning.
Wow, that's fantastic. This is fantastic. I never had this ability before, so this is definitely going to help me. Yeah.
Well, I love your enthusiasm. It's glad to have you on here.
But one question, I read a lot of stuff about blockchain, and I don't believe he's given us the New York Stock Exchange, letters or code for that particular thing that is coming out that he claims is going to be phenomenal. Is that coming in a booklet to the house, or is he going to let us know what the blockchain stock is going to be for this year?
I'm not sure what I do recommend a total position of 2%, 1% in Bitcoin, 1% in Ethereum. I would not have any other altcoins in your portfolio at this time. And again, if your position, we got investors into these 2 cryptocurrencies in December. So we're up huge on those positions. Just massive gains on that. But again, we're not recommending you ever go over a 2% position. So as your position goes above 2% of your total assets, we're pulling profits off. And as your position goes below 2%, you're adding to that position, which is a very brainless way to control risk, take profits when everyone's greedy, and to also add to the position when everyone's fearful. So that's my recommendation. I do know a lot about crypto. I absolutely would not purchase anything outside of those 2 currencies at this point in time.
Right,
And
right,
it
right.
does coincide a lot with gold. So it's kind of like silver relative to gold. Well, Bitcoin and Ethereum are more like a accelerated, it's like silver on steroids, perhaps.
Yeah, well, it's down. It was down over the holidays. I don't know what it is now. I didn't check, but it was down 200 points.
Oh yeah. So if you had followed our advice, you would have automatically been taking profits off of Bitcoin and Ethereum as they were rallying really high for the first half of 2019. And then you would be adding to it as it crashed. So I mean, Bitcoin's down something like 50% over the last 6 months or so, and then, or maybe it's the last 4 months, and then Ethereum's down even more than that. But yeah, if
Yeah,
you just stick to the guidelines of no more than 2% total allocation, you're going to see it works out really well. Now, I'll be adjusting which currencies are the best to own as the market cycle changes. Right now, we're still waiting for the next big event, which I believe will be the Fed being forced to cut interest rates to zero.
right, right.
And that'll be due to the yields in the treasury market getting so expensive it disrupts stocks.
Yeah, that's going to be a real problem. Uh, yeah, I didn't get into Bitcoin. I wasn't with you guys then. I've watched it a couple of times and people have made a lot of money on it, but it's mostly digital. So I was a little leery of that.
Sure, yeah. So probably your best bet is just to download the Coinbase phone app. Regulated American company backed by all the big VCs in San Francisco.
Yes,
And
I
again,
have
we're
it.
not trying to, trying to get out of taxes and get our money out of the country like a lot of people are with crypto. Really just a speculative hedge that coincides with our gold position.
Yeah, because you can't turn it into dollars. You can use it for different places are willing to take it, but you can't turn it into liquid. So,
Oh,
you know,
sure you can. Yeah, it's trading billions of dollars a day, so you can certainly liquidate. Absolutely, I'd recommend the Coinbase app for that.
yeah, I have the Coinbase app, but I was a little leery, so I was still looking for instruction on all that, how to put money into it, and can you liquidate it, and because I heard you couldn't put it into dollars, and I'm like, so how do you, from Christian Green over there with his thing.
Yeah, so it's trading very heavily. And again, I think this is a great entry point for anyone who is curious about it. No more than 2% of your total assets, period, at any time. Okay, so if your position goes up, you should be taking profits off. If it's going down. But yeah, we got investors into this in December with a very small position and continue to recommend that. And if you follow that guideline, you'll see you're forced to take profits as it goes up and you're forced to add as it goes down. And this
Right.
is the way to trade these highly risky assets. But yeah, it is trading just in the last 24 hours, $20 billion. So, or rather, let's see. Yeah,
Now,
$20 billion. So, you know how much of that's fake trading volume? Probably 90% of it, but it's still plenty for you to get in and out.
I see.
I've traded, 6 figures in these markets personally, and minutes to get filled into cash. So Coinbase is a great opportunity for that. And again, think of Bitcoin and Ethereum as your inflationary hedge that coincides with your gold position.
Mm.
And if you don't want to mess with Bitcoin and Ethereum, don't worry about it. We're going to capture the same returns, maybe not the exact same percentage, but the same concept is being realized in our portfolio through GDX.
Yeah, well, then I'm going to do what you say. I'm going to drop some stuff that I have and just go into GDX. Cool. I'm so glad I spoke to you.
Oh, good. Yeah. Well, I think you're going to find if you follow our trading plan, your life's going to be a lot easier because you're going to have less things to keep track of. Number one. Number two, you're actually going to be more diversified than you were before. So a lot of people end up owning a handful of stocks that they're familiar with. Maybe they worked for the company, so they're just getting piled up that stock. My father had worked for the same company for a long time. The stock did great, so he never thought twice, ended up with a huge retirement package, and it was all in one stock. I was like, oh my gosh, talk about business risk.
Yeah.
In the SPY
Yeah,
ETF,
I work.
we have 504 companies representing 40% of our portfolio. In emerging
Wow.
markets, we have 1,000 companies representing 10% of our portfolio. And even more important than trying to get a big return from emerging markets, if you want to do well with the markets long term, you better know what's going on in emerging markets. There will be no global growth story without emerging markets recovering.
Yeah,
So if we didn't
work
want
for,
to trade emerging markets, we better be watching it.
yeah,
Market's
I work,
critical, and then gold as well.
I worked for EF Hutton for a couple of years before I got married years ago. And I made money in the market, because I was the boardroom accountant. So that was good at the time, but things have changed since then, quite a few years ago. So I got back into it, I'd say about 3-4 years ago, and my husband passed away 3 years ago. So it's been, not really moving with me holding into certain stocks. So I'm glad I spoke to you, and I'm glad I got into this particular company. And I think just by listening to you and getting help over the phone would be a tremendous thing for me.
Oh, I'm so sorry to hear about your husband.
Yeah, he's gone. Anyway, I need to make some side liquid, because if I don't, I can't. I'm partially disabled. I won't be able to work. So I need some kind of liquidity on the side.
Sure. Well, yeah, it's great to hear your story because that's exactly what we're trying to solve. My background was actually more on the marketing and management side. So I had started about a decade ago and had all these people wanting me to sell their financial services. I was well known for being a marketing whiz and such. And so all these people would fly to my office and show me their trade results, and it looked
Wow.
great, but I knew nothing about it. Started helping their businesses and slowly became more and more interested in finance until I started, devouring every book, audio course, at the same time as managing all these different gurus. And I've represented every guru who's famous. You can't even imagine how many different gurus I've met with. And I found a few common problems. The first problem was that they wanted to trade their way, and that was it. They didn't care if anyone else was going to be able to follow the program. So you ended up with haphazard trades at random times of the day. Nobody knows how much money to put into it. A lot of times they're trading illiquid products that are moving quickly. So they're reporting these great returns, but I go put the marketing team to call up these clients, and lo and behold, we can't get a testimonial to save our life. And that's when they were relatively honest. Also, I started to uncover some of the dishonest tricks that advisories do. Sweeping bad trades under the rug,
Yeah.
all sorts of funny monkey business.
Monkey business, yeah.
In our program, let's see, let's get Scott on here. Scott, I love Scott's honesty. Scott, you got your audio today?
Hey, Jason. Yeah, can you hear me?
Yeah, so here's what Scott will reiterates this really well. Whether we're winning or losing, do you get very close to the results I get, Scott?
I do. And, I track this really closely. Even the TLT trade I did today. So I take a look at your mid price on your upside down collar that you put on, and look at mine and look at my mid price. And like you say, I actually got the mid price a little better than you did today, but that's because the TLT underlying had changed a little bit from the time that you put it on. But the whole point is I've just tracked the pricing for a long time. And if you have a little fluctuation in the 30 minutes of your alert, it's always a balance between when we put on this alert and your last alert. So I'm tracking the exact same results as you.
Excellent. Well, that's what I like to hear. So, the good news with that is when I do a good job and predict the markets, we're making a lot of money and everyone's getting the same result. And of course, the
Yeah.
bad news is when I'm wrong, we all hop on here together and get to enjoy the same loss together. But I think the transparency and clear accounting is probably what makes this service popular. Would you say
Wow.
that's right, Scotty?
My example this week is the rare time I didn't put on the TLT trade last week, and I really had no reason for it, Jason. I mean, nothing that was underlying in the fundamentals. Maybe I thought
Well, probably because
technically
I've been wrong on the TLT for 3 months. You're losing faith in me.
that week of TLT, it did work against you. But you can't look at one underlying in the portfolio because everything else had been working your way, and it's a balance. And so you have to look at what the total portfolio return is and not gauge a one winning underlying because they're uncorrelated. And I guess it was just a lesson for me this week to realize that that's important to follow the trade across all of the underlyings. And yeah, I would have been much better off this week had I followed it. And here's the other thing, Jason, and everybody knows this who follows you. There's a peace of mind of knowing that you're protected, because
Right.
while I was naked on the TLT, I was down 1.3% on the week, and I way underperformed the portfolio. So, and I was just grinding. I couldn't sleep. So I couldn't wait for the alert today to cover my TLT.
Oh yeah, those put options do make it easier to sleep at night. That's definitely for sure. Now I do want to note, guys, that I have some major improvements to the daily content coming in next week. So do expect the daily presentation to be almost completely unique. So on Tuesday, we'll really deep dive into emerging markets in a way we've never done before. On Thursday, we're going to deep dive into central banks and all the important ones that matter for our TLT trade. So Tuesday, Thursdays will be significantly different than the content we'll publish on Monday, Wednesday, Friday. So I've got some exciting improvements coming. I think you guys are going to really appreciate it.
Okay, that would be great. Tuesdays and Thursdays. Okay.
Yeah, so Monday, Wednesday, Friday will be a deep dive into everything that relates to US equities, our SPY position. Tuesdays will be everything that deep dives into really emerging markets. And then Thursday will be a complete deep dive into bonds and gold. So it'll coordinate with our schedule, but it won't be the exact same flow and content that we're used to seeing daily. So that's going to be exciting. I'm just doing a little more testing and background work. Okay, guys, I'm going to go ahead and jump into, well, let's see. Are there any questions on the trading plan before I move forward?
No, not from me.
Max, I see your hand is still up. Do you still have a question, Max Pula? Okay, great. Okay, guys, let's go ahead and go to the news. Okay, so we got the repo operations are continuing. They're a little undersubscribed recently, so that's a good sign if we want to be long equities. A lot of rumors on who on earth was causing all this or what the underlying cause was. Go ahead and hit the mute button. I'll unmute in a little bit. Jim Bianco is saying you're right here relative to the .com bubble. And I gotta admit, I like his forecast here. I'm expecting a very bullish stock market as bond yields rise rapidly in the first 2 quarters. After that, I think it'll really slow down and then cause a reversal. But I don't know if this is the big crash that lasts for 2 years going into November, as this chart would indicate, as I think we're going to get a mini crash and then we get the Fed to blow its last load in terms of protecting the markets by cutting rates to 0 and then doing real quantitative easing. Right now, they don't call this QE because they're not buying medium or long-term debt. They're just buying short-term debt that rolls over very rapidly, which means this increase in the balance sheet could slow down. And again, the S&P 500's gains are directly tied to the growth of the balance sheet. Here's a look at earnings getting ahead of, or rather the value of the S&P 500 getting ahead of corporate profit earnings. And this is all fueled from stock buybacks this time around. Last time this major decoupling happened was in the dot-com bubble. So even though we might be near a crash, remember this will probably rocket higher before it does so. And that's amazing after we had the best return since 2013. And remember that 2009 through 2012 period was QE1, QE2, and then Operation Twist. So a whole bunch of government, or rather central bank distortions. Okay, moving into the political news, there's still nothing going on with the impeachment. We got a whole lot of tweets from Trump and Giuliani, very little from the Democrats, so still staying tuned on that. Does look like Trump is set to win the election. Biden's now telling coal miners they should learn how to code. Just mind-blowing that they keep pushing him as the #1 guy. Meanwhile, we're trying to see a recovery in Asia. We're not going to see a long-term global growth story without a recovery, excuse me, in Asia. So we are seeing a little bit of a spike in the South Korean exports, which had been showing a negative. But I do think we need to be a little patient. The trade war is just getting, the trade deal is just getting signed January 15th. So it will take a little while for all these effects to really kick in. We're seeing some more threats out of North Korea, a new political risk to be aware of. Asia's exports do look like they're bouncing back up. So this is very positive for emerging markets and for our general 2020 theme. Singapore's growth has slowed down. So that's another warning sign. Hopefully we see that start to bounce back up. China is showing signs of easing, which is critical for emerging markets. And they've done this by lowering rates and releasing about $100 billion of cash. So also showing that they are joining in with Japan, the ECB, and the Fed to ease monetary policy. Conflict between the US and China in 2019 is the most intense in 30 years in history. The integration of different civilizations was sometimes achieved through conflict, even confrontation. I hope after this round of conflict, China and the US can be closer. So I'm not sure if they'll be closer, but perhaps they will take a break from fighting for 2020. I do suspect the trade war will reignite in 2021. This fellow is saying that Japan and Germany's stock market has not broken into new highs, although I suspect it'll take a little while for all of this bad news from trade war and rerouting trade routes to perk up into 2020. But you can see the DAX, the German index, is on the verge of breaking into new highs. If we go to charts now, oh, here's our Nikkei, also at the all-time high. So they're doing fiscal stimulus, plus they're doing pumping QE. My bet is they all break into new highs. Here's a look at the SPY. Little bit flat over the last 5 days. Big picture is this is a rocket ship. I do expect emerging markets and GDX to outperform the SPY in 2020. TLT has sold off for the past month and was up considerably with our down bet as of Tuesday, but this morning it popped up a little bit. And as I said, looks like the TLT is hanging on for its dear life. My target is for the TLT to go to about 120 before it causes some severe problems in the stock market. And at that point, I suspect we finally get a little bit of a stock crash and the Fed going towards zero. Now, I bet they will spread that out over the course of 9 to 12 months. So this could begin sometime in Q3, Q4, and last into the first half of 2021. Usually they do rate cuts first, which allows banks to pick up these bonds at a high yield and drive the value of the bonds up. And then they start doing quantitative easing, which allows the banks to sell the bonds not in an open market, but to the Fed. So they have no risk of making the value of their bonds lose value. So it's a sweetheart deal for banks, and it's something they've done time and time again. First the cuts, then the QE. So that's what I expect will happen towards the end of 2020 into 2021. So perhaps we see cuts Q4 2020, Q1 2021, maybe even Q2. So if they could spread out three or four cuts, this could last all the way into mid to late 2021. And then they begin going into some serious QE. So that we'll have to pay that in more close attention. It all depends on how fast this TLT chart tanks. Now, if we hit 120 in Q1 of this year, that'll be surprising. That definitely moves up the timeline on everything. What do I see long-term for the TLT? When they cut rates for a period of 6 to 12 months towards zero, I do believe this could drive the TLT into new highs. And based on where I've seen German yields get to, my highest target on the TLT is going to be in that 170 to 180 range. Now, if they start talking about negative rates as a great idea because of how well it served Japan and Europe, then there's even a potential higher range for the TLT. So I'll be paying close attention to all of the FOMC minutes and interviews in terms of what their plans are when we do approach the zero bound. And the big picture is just that governments are spending more than they make, and this is forcing central banks to slowly but surely drop interest rates and buy up debt. And this trend will most likely continue until we get to zero on rates, and then we'll see what they do. Do they take the path of Japan and just keep it at zero for a long time? Or do they hike interest rates and protect the dollar? From my personal hope, I hope they hike interest rates and protect the dollar, but we'll have to play that as we get there. Understanding what the Fed's most likely to do is extremely bullish for gold. Now, spot gold, as I said, could have somewhat of a ceiling because central banks have a printing press and they're buying it up at $1,500 an ounce. Could it go higher? Sure, but GDX can go significantly higher much faster. So if we look at the 2012 rise, we got to 66. The problems then are far less than the problems now. My target is probably upwards of $100 on GDX towards the end of 2021, 2022. And that's how long I think this is all going to take to play out. If it happens faster, then GDX could hit these targets much quicker. Emerging markets having a heck of a month. In fact, almost all of its gains of the year in the last month. And so targets for this are to break past that 52 level. And again, our Tuesday presentation will really zone in on who are the top imports and exports relative to China. We're going to be studying what are they doing at their central banks in terms of quantitative easing. And we're going to be looking at the health of their stock markets to try to gauge, do we really have a recovery in Asia and China specifically? Or is this ETF going to tank and bring down the rest of the world with it? So that's really the critical question of 2020 to focus our attention on. Okay, I have a list of risky banks. Deutsche Bank, HSBC, and SoftBank have been doing a lot of deals together, essentially just massive derivatives speculating on interest rates on various loans. So there may be like a $10 million loan to some little company, but then hedge funds are coming in and making bets on that loan to the tune of hundreds of millions of dollars, and then taking that derivative and using it as collateral to get more money to go to the stock market. So it's a big nightmare. As Buffett says, it's a instrument of mass destruction. So Deutsche Bank has lost 90% of its value in the last 5 years and is a critical bank to look at for insolvency. And a lot of people speculate that they are the main cause of the repo shortage. They're up 4.5% today. So the risk of a major bank going under right now seems muted, although it's being covered up with lots of quantitative easing. IHY is the next few charts are different bond ETFs. I'm looking for any one of these to sell off rapidly as a sign that there's problems in the credit markets. So IHY is sovereign debt in foreign currencies, high yield debts. It's very similar to HYG, your junk bonds in US. These are the junk bonds abroad in foreign currencies, both looking very strong. The higher these go up, the cheaper it is for corporations to borrow. And this is not your top corporations. This is your midsection, like your Russell 2000. So no problems there. LQD is your investment grade bond ETF. This does represent a huge chunk of the volume trading in and out of these high level corporate bonds, again, at record high. So your Apple, Microsoft, Amazon has access to super cheap capital to buy back its own stocks. So we're keeping a close eye on that. No signs of problems there. iGov is your European low yield debt, which I really think might be one huge problem area for the bond market. All these super low yielding bonds, I believe, we're starting to rotate into the TLT, or rather US products. And I think that's what's giving the TLT a little bit of life right now. But the big picture is these yields are far too low. A lot of it was in negative yielding territory. So they're absolutely worthless bonds to buy and hold. Only reason to own it would be to suspect that the yield will go even lower and that 2020 will be a global slowdown and not a recovery. So I do suspect this iGov could be one of the first bond markets to crash really hard, and keeping a close eye on that. Okay, moving on to the yield curve. Oh, where'd it go? Okay, looks like this is the most. Let me zoom in. Okay, so the colors go from August. We have the inverted yield curve. What's the inverted yield curve? That's where short-term yields are higher than somewhere else on the yield curve. So it doesn't make sense to get 2% for a 1-month loan to the government, and then you only get 1.3 for a 5-year. And so every time this happens, we've had a recession within 18 months. So the Fed had an emergency meeting in September. It wasn't even in person, it was a webinar, and they decided to start up not QE, as they call it. And so what was the effect? They started buying the 1-month, 3-month, and 1-year bonds in massive pace. In fact, they started selling mortgage-backed securities and loading up on the short end of the yield curve. And so the effect has been is that the front end has been muted lower and the long end has begun rising. And so I think this trend will continue. They're pumping about 100 billion. Just if you look at the total growth of the balance sheet, it's $100 billion a month since that call. But if you really calculate that they also were selling mortgage-backed securities at the same time, they're buying upwards of 110 to $120 billion a month and holding in treasuries. And a lot of that debt is rolling over every month or every 3 months. So they're just buying massive amounts of the front end of the US government's debt. In fact, people are calculating that they've purchased some 90% of the debt we've issued since we went into QE. And so there's a pretty stable prediction that we can make. If they do QE, the long end of the treasury rises and stocks go up. If they cut rates, the opposite happens. It's usually in the face of stocks crashing. They begin cutting rates, and then you get lower yields. And so they usually don't do the two at the same time. And it allows for us to have a relatively simple game plan for how to deal with that in the stock and bond market. Now let's go back to 2018 so we can see what happened. I think it's going to be very similar to what played out in 2018. So you can see in January, here's your yields. Your 30-year had a 2.95. Your 10-year had a 2.7. Remember, stocks were going up, at least in the US. March, they slowly rise a little bit. May, they go considerably higher. June, they jump even higher. And then we get to September. This is really what broke it. That 10-year gets above 3%. And by October, we're sitting at a 3.15, 3.3, and 3.4 yield on a 10, 20, 30-year treasury. And that broke the stock markets back. We had a 3-month correction. And again, this was in the face of the Fed hiking interest rates and doing quantitative tightening, and in the face of a global slowdown. We had emerging markets crash. We had the rest of the world really crashing all of 2018. So it's not the exact same environment, but it's very similar. My expectation is we won't get anywhere near these yields before the market has a crash this time around. So I'm looking to get bearish on stocks and to get bullish on bonds when that 10-year gets close to 3%, probably around 2.8. So if these predictions are right, we should have a pretty massive rally in stocks and a pretty quick crash in bonds early on in 2020, while we find better and fairer prices. And then as these yields start to creep up, I believe that the stock market rally will dramatically slow down as money starts to figure out, hey, if we buy a 10-year with a 3% yield, well, number one, I can't lose money because inflation's below 2%, so I have a guaranteed profit. Let's leverage up on that trade. And then two, if we do get a stock crash because of these high yields, we know exactly what the Fed will do, which is cut rates. So that means this yield's going to drop lower and the value of the bond will go sky high. And that's just what they do over and over and over again. It's a great setup for banks. And then after they cut the rates, they do QE. So there's no risk of selling your bond position, especially if you have a massive position, which our primary dealers do. They can get out at a huge profit with no risk of ruining the price because of having such a large position to unload. The Fed's going to buy it all up and vacuum it out. So again, I think this will most likely play out towards the end of 2020, but if it happens faster, we will be ready. It's a pretty simple call in that term. Okay, great. So that's really our major forecast and what we're really focusing on early on and into late 2020. Any questions out there? And I will open all the mics up too. So if you have any comments or questions, please go ahead.
Hey, Jason, I'll just add, since you were showing 2018 there, you know, that's when the S&P was crashing, and I managed my 401k, and right at the bottom, I couldn't stand the pain anymore, so I hopped out. Of course, it did a V bottom and retraced right back up, so I missed out. I rode it all the way down and missed out on the gain. The portfolio builders portfolio really did great in that time. That was before I was a member, but you know, you
That's when we were
highlight that
talking
you did
on, me
really
and
good.
Scotty were talking on the phone, and someone was telling them about a bear flag, huh?
Yeah, and one of the things, I know you don't advertise this, but one of the things that I love about this program is it gives me confidence to stay in the market in my 401k. And I have the option to buy just kind of an SPY proxy and a bond proxy. And so where I would be jumping in and out and probably missing, you know, it seems like my habit is to do the opposite of where the market is. Being part of your, having the benefit of your analysis, I've done a lot better in my 401k just by being just by following your analysis. See, I would be out of the S&P right now if it wasn't for you, because I'd be afraid of this top, and I would have missed out on a lot of the gains that we've had over the past month. So I know you don't advertise that, but I like following the trades, and I also like this just for my 401k portfolio.
Well, thank you so much for the kind words, Sky. Really appreciate it. All right, guys. Well, that was a great webinar. It was really nice meeting some new folks on the phone. So thank you for participating. And don't forget, tomorrow we're going to look at how much money did the Fed add to their balance sheet. And that will give us a good idea of just how bullish we should be next week. So thank you, everyone. And I hope to see you tomorrow.
Okay. Chef.